Picture it, decades previous, an onlooker, fresh to the city, in awe of the New York financial district. Seeing the bankers' and brokers' magnificent yachts, he jokingly asked, "But where are the customers' yachts?" Today we see the echo of that humor in stark reality as we unravel the world of high-frequency stock trading and the complex landscape of high-risk derivatives. This, my friends, is the world of the gamblified financial markets. Magnificent ships sailing around the Battery, a marina crammed with opulence and display. The cost of these snazzy yachts, paid by none other than the clients of these financial institutions, their investments constantly churning commissions, fees, and spreads. The high-octane Wall Street scene is one of constant transactions, movement, and number crunching. Each transaction, buying or selling a financial instrument, generating money for the brokers through commissions, fees, and spreads. This merry-go-round of transactions makes fortunes for intermediaries. It's even been argued that investors, or let's say the more mundane title holders, have always funded these extravagancies, even during the days when economics suggested a world where all investors got fair returns for bearing risk. Economic theories such as the efficient market hypothesis stated that the stock market's ability to form accurate prices constrained even privileged insiders from making added profits. This seemingly perfect world, however, had a major assumption: fully rational investors maximizing their utilities. Modern theories and observations have instead shown us that investors often exhibit bounded rationality, limited by predilections, cognitive capacity, and behavioral biases. Resultantly, markets sometimes fail to produce perfect prices, and these irregularities, or anomalies, in financial pricing affirm the fallibility of the traditional, efficient market hypothesis. And this is where the plot compels us to feel for the common retail investor. They often shell out more than they ought, shifting vast quantities of wealth to intermediaries, but without the promise of higher returns or better services. This is somewhat reminiscent of the gambling scenario, where the house always wins. That is, the gambling operators always take home profit, with minimal risk on their part. The parallel between financial investments and gambling is only distasteful when the vast majority of retail investors, the common investors, are exploited. But there lies the bitter truth of the matter. All the while the fees for these intermediaries are guaranteed, the investor's profit is anything but. Quoting John Maynard Keynes, "The markets can remain irrational longer than you can remain solvent." Inefficiencies in the market may indeed haunt the investor, while fraudulent or manipulative trading practices add to the risk and loss. Let's talk for a moment about gambling. It's a word loaded with sentiment, mostly negative, linking to pictures of unchecked risks, wasted resources, and spiraling losses. Now let's talk about investing. This term, in contrast, often paints a more positive picture, one that evokes visions of calculated risks, prudent decisions, and steady wealth accumulation. However, an emerging trend is blurring these boundaries. We have entered an era of what can be called the gamblification of investing. This is a phenomenon in which the lines between investing and gambling are becoming increasingly fuzzy. Sleek mobile investing apps have made investing more accessible than ever before. Nowadays, anyone with a smartphone can trade stocks, buy options, or bet on cryptocurrency prices. With the allure of quick and significant returns, investing has been transformed into a high-stakes game, with too many unaware players. Unfortunately, the links between problematic investing behaviors and harmful gambling is becoming even more evident, presenting critical implications for individuals prone to gambling-related harm. The gamification features like badges, leaderboards, and social competition tools used in these apps play into the psychological tendencies of investors, potentially leading them to make emotionally driven and risky trading decisions. This evolution of investment spaces, very similar to the high-risk potential wins found in gambling, is not only drawing in a larger pool of investors, but also exposing them to a level of risk usually reserved for seasoned professionals. Even the regulators are standing up to take notice as they grapple with the complexities of overseeing this new hybrid market that mixes the calculation of the stock market with the rush and unpredictability of a casino. As technological advances continuing to blur the once clear lines between investing and gambling, education and awareness become even more vital. After all, without a clear understanding of the stakes, investing without knowledge can quickly become a roll of the dice with life savings on the line. So the next time you log into your trading app, It may be wise to remember that being drawn in by the flashing lights and promise of quick riches is the first step down a potentially perilous path. Remember, slow and steady might not just win the race, but also help you steer clear from those catastrophic crashes. Let's dive into the phenomenon of high-frequency trading. Also referred to as day trading, this is where buying and selling of the same stock takes place within a single day. As the title suggests, this method is all about speed and timing. While this form of trading might make some investors quick profits, it's also incredibly risk-ridden. The market changes every second, and gains can quickly turn into losses. Some studies have found that around 95% of day traders actually lose money, illustrating the perilous nature of this trading style. Indeed, the frequency and speed of trading might sound thrilling, almost like a gamble, but remember, it's the house that always wins. This is where the connection with gambling comes into play. Think of high-frequency trading as the roulette wheel of stock trading. You place your bet, the wheel spins, and where it lands determines your fate. But unlike roulette, where the wheel spin is entirely random, high-frequency trading involves making educated guesses. The difference, however, is that the highly volatile nature of the stock market can make these educated guesses feel quite a bit like taking a stab in the dark. It's not just about playing the market and hoping for the best. Successful high-frequency trading requires a deep understanding of market trends, alongside speed, precision, and not to mention, a robust risk management strategy. The advent of mobile trading apps has fueled the rise of high-frequency trading, making it far more accessible. These apps offer everything from real-time financial news to sophisticated analytical tools right at our fingertips. But be warned, the more these apps make trading look like a game, the more it starts to feel like one too. And as any seasoned gambler will tell you, the house always has the edge. In this case, the yachts belong to the brokers. So it's crucial to approach high-frequency trading with knowledge, caution, and a healthy dose of skepticism. So where does this leave us? We need to contemplate upon the perilous crossroads of investing and gambling. What's crucial is an informed approach, balancing risks with rewards, and above all, a clear understanding that all that glitters might not always be gold. Thank you for watching. Keep learning, keep investing, and keep growing. If you found this video informative, do like, share, and subscribe for more such content.
Brewsonic,